Continuing to talk about the Secure Act and your retirement planning today on Your Wealth Health with a special guest. Join me. Hello and welcome. I'm Eric Brenner, president and founder of Hilltop Wealth Solutions, and it's great that you could join me again here, Your Wealth Health on Fox, Michiana. Very excited today to talk and continue our discussion on the Secure Act and retirement planning and really what's best for you. Today, again, Beth Foley, a partner with the firm's joining me. Beth, thanks for joining me today.
I'm glad to be back.
So very excited about today and continuing our discussion.
There's more to learn about the Secure Act.
Absolutely. Well, we've got a special guest, and I really want to get to that guest. So many of you may have heard of Ed Slott. Ed Slott is often known as the IRA expert. He does a lot of teaching around the country and actually has raised millions of dollars on public television, educating consumers as well as teaching advisors about IRA planning. And I'm a member of his Elite Advisor program, which is 400 advisors around the country. So when you think about having over 300,000 financial advisors plus, there's really only 400, and I'm fortunate enough to be one of those advisors. And my guest today is Sarah Brenner, who, by the way, is not related. Sarah is an attorney and director of retirement education for Ed Slott and Company. Sarah has worked for almost 20 years helping clients solve complex technical IRA questions, and she's been contributing writer for many IRA articles, training materials, and has been quoted in national financial and tax publications. She's the contributing writer and editor for the Ed Slott's IRA Advisor newsletter, which is distributed to thousands of advisors nationwide, and she also writes for several areas of companies' websites, and she serves as a valuable resource, I know, to us here at Hilltop Wealth Solutions often. So Sarah, thanks for joining me today.
Thank you, Eric. I'm so happy to be here with you.
Yeah, it's a great pleasure, and Beth and I are really excited. So we've been talking about the Secure Act. Last week we talked about it and kind of saving for retirement. A lot of changes that happened January 1st, wasn't there?
Yes, absolutely. The Secure Act really upends retirement planning. A lot of big changes. The Secure Act was tucked away in a big spending bill that got signed into law at the very end of the year, and it's meant big changes for everyone's retirement accounts.
I know, your company and educating us last year thought this thing was going to go sooner, didn't we? We thought maybe it'd get passed sooner.
Yeah, we've been following the Secure Act for a while. It passed the House back in summer, and then it kind of stalled. Nobody really knew what was going to happen. And then as 2019 was winding down, Congress got to work and the Secure Act passed. The president signed it into law, and most provisions were effective January 1st, 2020.
Great. So in your view now, I know you had shared with me you've been very busy, obviously, with the new legislation and that whole package and helping folks along the way. What are a couple key points that we should be thinking about?
We've been swamped. We've been so busy. We've been getting lots of questions from our clients. Their clients have been coming to them with a ton of questions. One of the biggest questions that we've been getting has to do with a provision in the Secure Act that allows people to delay required minimum distributions. The age has been 70 and a half. You have to start taking distributions from your retirement account once you reach age 70 and a half. The Secure Act pushes the age back a little bit. It pushes it from 70 and a half to 72. So this is a good thing because a lot of people, they don't need the money in their retirement account. They don't want to pay the tax bill when they take their required minimum distribution. So the Secure Act does allow people to put it off a little bit. Where we're seeing a lot of confusion is the question of exactly who is allowed to delay their RMD until age 72. And unfortunately, the Secure Act does limit that ability. Only people who are 70 and a half in 2020 or later can take advantage of the ability to delay their RMD until 72. If you turn 70 and a half in 2019, you're out of luck with the Secure Act. You had to take your RMD for 2019 and you're going to have to keep going.
Yeah, that's a great point. I know we've ran across that already, don't you think, Beth?
We have. There were people thinking that they could, even though they'd started, that maybe they could put it on hold for a little bit, but that's not the case, is it? If you were 70 and a half in 2019, even if it was December 31st, then you have to stick to the old rules. Is that correct?
That's right, Beth. If you were 70 and a half in 2019, unfortunately, you can't take advantage of the Secure Act. That's going to be limited to people who turn 70 and a half in 2020 or later.
Could I ask you a question about ages? Because one of the tricky parts under the old rules is, 70 and a half, and when do I start, and how do you calculate 70 and a half? The new rule makes it a little bit easier, right? Could you talk a little bit about, is it when you turn 72? Is it in the year you turn 72? Just a little bit of clarification, because it's easier now, right, than it had been before.
Yes, Beth, you are exactly right. One good thing that the Secure Act does is it does away with the 70 and a half confusion. It's always been a little bit tricky for people to determine when they need to start taking RMDs, and that's because we had that strange age 70 and a half. That's 6 months past your 70th birthday. So if you hit that point in 2019, you were 70 and a half in 2019, and you are under the old rules. If you're 70 and a half in 2020, you get to use the new rules. And there's actually kind of a shortcut that we've been sharing with people to help them figure this out. If your birthday, your 70th birthday, was July 1st, 2019 or later, you get to use the new rules under the Secure Act. And as you said, it's going to be a whole lot easier going forward because the Secure Act is going to do away with that 70 and a half confusion. We'll be able to say, okay, the year that your 72nd birthday falls in, that's the year that you have to take your first RMD, and that's going to be a lot easier for everyone. So that's a good change.
Does that, under the old rules, you had until April 15th of the year following your 70 and a half birthday to take your RMD. Does that April 15th follow into the Secure Act, or is it in the year that you turn 72, by December 31st of that year, you need to take or have your required minimum distribution completed?
The Secure Act keeps the old rules, which allowed for a required beginning date. It used to be the required beginning date was April 1st of the year following the year you turned 70 and a half. It's now going to be April 1st of the year following the year you turn 72. So we still have that April 1st date. We still have that required beginning date. And that's okay. Helpful because it allows people to wait and delay their RMD just a little bit longer.
Yeah, that's some great information, Sarah. Hey, Sarah, can you stick around for another segment?
I would be happy to, Eric.
Okay, great. Well, when we return to Your Wealth Health, we'll continue the conversation with Sarah. I do want to remind you that if you don't get a chance to watch us every week on Fox Michiana, you can follow us on yourwealthhealth.com. You can also follow us on Hilltop's Facebook page, Hilltop Wealth Solutions. and make sure that you catch up with all of the information that we will be sharing with you. When we return, Beth and I will continue with Sarah Brenner.
BNI, or Business Network International, is a huge organization, and today we're in 75 different countries with over 9,000 chapters and 260,000 members, almost 250,000. What it does, it gives a platform for a business owner to generate business for their company. That's really the sole purpose of BNI. So we would invite you to visit a chapter sometime and see if it works for you. If it doesn't, that's fine. What's the worst thing that can happen? You met 30 people you didn't know before.
Welcome back to Your Wealth Health, and we're here with Sarah Brenner, a tax attorney and Ed Slott IRA expert, talking through the Secure Act and some of the changes that happened January 1st. So Sarah, one of the things that we run across a lot is qualified charitable distributions. And we've gotten some questions already from clients as to what has that, how's that affected with the 70.5 to 72?
Well, Eric, there's been a lot of confusion about this. The Secure Act did raise the age for RMDs to age 72. However, it maintained age 70 and a half as the age for QCDs. So a client is still going to be eligible to take a QCD at age 70 and a half, even though they don't have to take RMDs until age 72.
Yeah, so it's kind of disconnected now, almost.
Yes, so a little bit disconnected, but it's a good thing because that gives more people the opportunity to take advantage of QCDs, which are a great tax break that are probably underutilized.
Yeah, I think, Beth, we see that, don't you? That we see really underutilization of those qualified charitable distributions.
I will tell you that in my career, I have never encountered a topic that is so well received. Mm-hmm. When I share that, and at this point in time, you would think that qualified charitable distributions would be a really well-known strategy, but I still run up against people who have not heard of it, and as soon as they do, are ready to jump all over it. So qualified charitable distribution now, still with somebody at 70 and a half, can give directly from their IRA to a nonprofit organization of their choice and have that gift go on a tax-free basis. And then once they hit age 72, then any qualified charitable distribution that is made also counts against the required minimum distribution. So there's a triple benefit going on here. You meet your portion or all of your required minimum distribution. You're helping an organization or a group that you support and want to support, and you get to do it on a tax-free basis. So it's a great strategy, and one that I hope people, if you have IRAs and you typically give to 1 or 2 or 20 nonprofits, a qualified charitable distribution is a great strategy to make use of.
Yeah, and so along that line of kind of giving, Sarah, so how you give an IRA to your spouse versus a non-spouse beneficiary, maybe children, niece, nephew, and so forth. Can you share with us just the highlights of the change of the Secure Act with the IRA giving?
Yes, the Secure Act has made big changes when it comes to estate planning with IRAs. The rules are very different now. In the past, we would talk about the stretch IRA, and quite often what people would want to do would be leave their IRA funds to somebody who is much younger, maybe a child. And then the child would be able to stretch distributions from that inherited IRA for years and years, for decades. Well, unfortunately, the Secure Act upends that strategy. The Secure Act does do away with the stretch IRA for most IRA beneficiaries. Most IRA beneficiaries, there are a couple of exceptions, but most IRA beneficiaries are going to have a 10-year payout period instead of the stretch. So that's a big change.
Yeah, and they don't really have to take it evenly out, right? They can take it out anytime during that 10-year period.
Yeah, the 10-year period is really interesting, and it's a great planning opportunity because there is, as you're saying, Eric, a lot of flexibility there. When we talk about required minimum distributions, we're used to talking about annual payments that need to come out. That is not how the 10-year rule works. Within the 10 years, a beneficiary has complete flexibility. They could take a little bit out each year. They could, skip years where their income is higher. The only requirement is you do need to clean it out within 10 years of the year of death. Otherwise, you're facing a pretty hefty penalty. There's a 50% penalty that applies if that account is not cleaned out within 10 years.
So really it brings in a lot more planning because someone may, maybe it's not in their best interest from a tax perspective to take it out in the first 4 years, but then evenly take it out over the next 6, depending on the situation. Brings a lot more planning into play.
Yes, absolutely. The flexibility of the 10-year rule is going to be a big planning opportunity. It's important to realize, too, that these rules that we're talking about apply not only to traditional IRAs, but they also apply to Roth IRAs. So there's an opportunity there with the 10-year period and an inherited Roth IRA. Roth IRAs, distributions from them are generally always going to be tax-free. So a beneficiary might consider not touching the inherited Roth IRA until the very last possible minute. They could let the money in the Roth IRA for the full 10 years and then take a distribution. That would increase the time for those tax-free earnings to continue to grow in the Roth.
Yeah, I think that's a great point because I think a lot of folks wouldn't even think about a Roth IRA being involved in that whole 10-year process. So
I have a question for Sarah. Sarah, what if somebody already has received an inherited IRA and they're already having to take required minimum distributions? Does the Secure Act relieve them of the RMD, or do they stay functioning under the old rules?
Beth, that is a great question, and that's one we've really been getting a lot. There are many inherited IRAs that were established years ago. Those accounts are going to be grandfathered. Any account where the IRA owner died in 2019 or earlier, pre-2020 deaths, those accounts are all grandfathered and the old rules will continue to apply. So those beneficiaries are not going to be affected by the Secure Act and they can continue the stretch.
Thank you.
yeah, that's a very important point. So because we have a lot of clients I know that are in that situation.
We do have a lot of clients that are in that situation, and it's a question that I've been getting over the past couple of weeks as well, with regard to, well, do I stop? Can I stop? And it's actually to their advantage to fall under the older rules.
Yeah. Well, Sarah, I really appreciate you joining me today and joining Beth and I and answering some of the questions on the Secure Act and some of the changes that have taken place. Your insight was very helpful.
Thank you so much for having me, Eric and Beth. It's been a pleasure.
All right. Thank you.
Bye, Sarah.
When we return to Your Wealth Health, Beth and I will continue to talk about the Secure Act, wrap up some of the discussion we've had with Sarah, and talk about other couple key things that you should know coming up. Welcome back to Your Wealth Health, where today we're talking about the Secure Act, retirement planning, helping you with some information to help you make some good financial decisions. I did want to mention an upcoming workshop series that we have in a couple weeks, Thursday, March 26th and Tuesday, March 31st at the Holiday Inn on Douglas Road. Those will start at 6:45. And the topic will be how to maximize your Social Security benefits in retirement. So if you're one that is getting close to retirement and you really want to understand more about Social Security and making the decisions about Social Security, it's really important to understand it. It is a pension for you, and the decisions there could be very costly. So you can go to our website, hilltopwealthsolutions.com, and sign up. Typically those fill up rather quickly. So Beth Foley joins me, and we had a good conversation with Sarah Brenner, no relation.
No relation.
And Sarah obviously does this every day, all day with the Secure Act and retirement planning. And so, as you think about some highlights, Beth, what are some important points?
Well, what was important to me is that, and I made use of Sarah's time while she was here, is that I have had clients asking about, what do I do if I'm already taking required minimum distributions from an inherited IRA? So I was grateful that she was able to clarify that for us too. And then the second point is having required minimum distributions from your own IRA or qualified plan delayed until age 72. That just gives you, 18 more months of potentially more growth in your account, which could potentially mean a higher RMD to take, but more money to work with from the beginning.
Yeah, that's a great point. Now, one of the things that I know we wanted to touch upon is, Sarah mentioned it about the stretch IRA. So basically, leaving your IRA money to what's called a non-spouse beneficiary. And, just for clarification, the stretch IRA, you won't find that in any tax code. That's just, what it's kind of been coined as saying.
That's
is that
the terminology.
You stretch the IRA. But, what we've seen over the years is if somebody has a sizable IRA and they really want to control the payout to their children, as an example, then they would pay the proceeds to a trust.
Correct.
And it would in our old world, it would force those payouts every year, and it kind of took the decision off of the table.
It was the IRA's way of controlling from the grave how their ultimate beneficiaries received those assets. So an IRA plan owner would name the trust as their beneficiary on the IRA, and then children or grandchildren would be named as the beneficiaries of the trust, but then the trustee would maintain control in making sure that the required minimum distributions came out systematically. And to Sarah's point, that doesn't matter anymore because you have 10 years.
Yeah, I've already heard, Ed Slott, who, we utilize as a technical resource. Ed says that trusts don't play well with the new Secure Act.
They don't, because of the time frame that's on it at this point. Everything has to be out within 10 years.
Yeah, so I think that, one of the recommendations would be that if you have a IRA trust, that you need to get that reviewed by a qualified attorney.
Correct.
And I know right now, just based on some discussions with attorneys and within our field, that they're just trying to figure it out on how it's all going to work together now.
This is a whole new set of rules, as we stated last week, and as Sarah mentioned again. This is the largest change in the tax laws in quite some time. So what we're finding, as Sarah mentioned it, and we've talked about it, is that a lot of things are under review by attorneys. The topic that we mentioned last week with regard to 529 plans, I contacted the state of Illinois about their 529 plan and how this would all play within there. And I was asked to give them a call back in a few weeks because they have it under review. So this was all just passed and put into place on January 1st. So there are a lot of things to be reviewed and incorporating them into trust dialogue, IRA designation, dialogue and so forth. So it is coming, but there might be a little bit of patience needed to get firm answers on how it plays in the day-to-day world.
Yeah, and I know I'll talk about this in a future show, but oftentimes people say, well, my IRA, it's got money in it, and but it's not really going to grow to anything significantly, nor are my required distributions going to grow. But you mentioned it earlier that there's more time now for that to grow from 70.5 to 72. And we run across a lot of people are shocked as what their required minimum distributions are going to be at age 80 or 82, 83.
Exactly. It all of a sudden looks like a whole lot of money, and they think about that of possibly it's money that they don't need, and yet they're forced to take it out and pay taxes on it because the IRS has been allowing it to grow for all of these years on a tax-deferred basis. So that's where things like the qualified charitable distributions come into play, and it really is, there are lots of planning opportunities within here too of how to incorporate this in, and talking to an advisor can help with that.
Yeah, and Sarah did mention the qualified charitable distribution. We talked about it, and you had mentioned that it's and Sarah, it's underutilized. In fact, I ran across somebody new that I met just recently, and has been taking distributions for several years, and he's charitably inclined, and has never been brought up to
Was never
use
brought
it.
up at
Never
all.
brought up at all to use that. And just to be really clear, is that it comes right off the top. Especially with the tax law changes that went into effect January 1st of 2018, being able to itemize. I heard some statistics that about 15% now of taxpayers are actually able to itemize. Everyone else is not.
Under the standard deductions, right?
Yeah, and so it's even more important if you can give to charity and take it right off the top. That's really important. The other thing I think is important to mention for our viewers is that their custodian, whoever houses the money, doesn't really have a reporting mechanism on that. So their 1099, if they give money to the charity, it won't reflect on the 1099.
It does not reflect on the 1099, and so that's why it is critical that you, as the IRA owner who's making the gift, or your advisor or your accountant, is keeping track, so that when you get your 1099-R with accounting for your distributions, that you know how much of that distribution actually went as a qualified charitable distribution. And so that's important here at tax time as well for anybody who made qualified charitable distributions last year, to know how much you gave, so you know how much to tell your tax preparer that I didn't use that money, I gave that away, so it is not taxable.
Yeah. Yeah, those are great points. So, well, Beth, thanks a lot for joining me today.
This was great. I'm so happy to have Sarah here,
Yeah.
and to get her expertise on everything. And I know that there is yet more to talk about with the Secure
More
Act.
to come. That's exactly right. So, if you have questions, and the way we think about retirement planning is when you're coming down the mountain, and 80% of all deaths in mountain climbing happen on the way down. So coming down the mountain in retirement planning includes coordination of income streams, risk tolerance, the Secure Act issues we talked about, receiving money, how you go about distributing money, estate planning, all of those issues, and how you really coordinate it to your benefit. We're here to help. At Hilltop Wealth Solutions, we are fiduciaries, which means that we must always act in the best interest of the client. We're not here to sell products. We're advisors, and we want to help you along the way. So I'd encourage you to visit hilltopwealthsolutions.com and go ahead, and we have a 30-minute free call. We'll find out more about you. You find out about us, and we'll see if there's a match. Next week on the show, I'm going to have another private wealth advisor, Bill Davis, join me. We're going to dive even more into the Secure Act, talk about some specifics, give you some strategies, and hopefully help you make some better financial decisions. Until next time, thank you for joining us on Your Wealth Health.